Hey everyone, hopefully you're having a good day. My name's Andy, my channel's Finding Value. Today I'm going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it together, generally related to three different topics: wealth building, commodities, and or financial topics. Let's dive right in, take a look, see what's going on today. If you want to follow me, it's at @Finance, and if you want to join our community, finding-value.com, where I dive deeper into all these topics, sectors, looking for investment opportunities, sharing those opportunities with everyone in the community. I try my best to get you guys in as low as possible and get you the opportunities for you guys to select what you want to do. If that sounds interesting, check out the special coupon code that we've got in the corner there. It's $25 for the first month only on the monthly membership, and it's a $500 charge for the yearly membership. And you can always swap from the monthly if you just want to try it out into the yearly after that first month if you decide to stick in the community. Cycle investment strategy: a rally in oil and in agricultural commodities, which are likewise forming a significant breadth low, would further fuel Latin America's resource-heavy economies. The current narrative in the oil sector is structural oversupply. Oil prices typically bottom when such narratives dominate. Waiting until official data already shows scarcity is not a good idea. The oil market does not react so inefficiently to public information that every retail investor would get a risk-free entry. So this is Latin America. This is commodities. They trade the same way, which is ultimately the value of the dollar. That's what combines these two together. That's what ties it all together. A weaker dollar pushes other commodity currencies up. It also pushes commodities up because, well, they're priced in dollars. So that's the relationship here. I think that these are both going to go up with time. Oil, Latin America, a lot of other different commodities, fertilizers, they're all going to go up because they're all tied to the dollar. Latin America is the inverse of the dollar. Commodities are also the inverse. The prices go up when the dollar goes down. So, talking about this second portion, it says waiting until official data already shows scarcity is not a good idea. You can't use news for your indicators. The news, it's a twofold thing. The news it's an extension of the herd. It's herd thinking. Also, the news can be used to manipulate the herd into thinking that there's this large supply in the market. What you want to use is you want to use chart patterns, and you want to use those technicals and the patterns to get your entries. You want to see smart money accumulating. So it's not so much about narratives. See, this is what's really difficult. Everybody wants to understand why. Well, why did this go down? Why is it so cheap? Why? And it's like, well, everyone has to convert a price movement to a narrative. And then the person who wants is asking the question of why, they want to accept some sort of story, a reasoning of why. Well, markets go through cycles. They're bullish and then they become bearish for whatever reason. Some of the narratives are made up. Some of the narratives we understand. So what I would say is markets cycle up and they cycle down. First wave up, second wave down. Whatever narrative you want to put to it, whatever reason that you want to put to it, doesn't mean that that is the correct reason. There's a whole bunch of people in the market, and here's my reason. You want to hear my reason? Check this out. The majority of the herd, what they do is they just chase price. So when we started getting this undervaluation in 2020 where the smart money purchased, everyone started to chase that price movement in commodities. In 2021, we saw visibly on Twitter, you may have even participated yourself. Everybody ran into commodity stocks in 2020 and 2021. What was the reason that most retail buyers, why did they buy something? And this is what I'm going to say. They were chasing price movements. They were chasing price movements. So what do you think happened on the back end here? As smart money started to sell, or as investors started to sell, what do you think the retail people did? Oh my God, the stock is going down. I better sell it. It's 100% based off of price movement. So retail chases price up and they sell when the price goes down. They're just reacting to price movements. Do you ever hear that as an explanation? Now, how do you buy the bottom of 2020 or 2016? Well, that'd be like buying right now. It'd be like buying right now because we're back testing on this breakout. And then we're also incredibly cheap in relationship to other asset classes, crude oil is, and commodities are. So you can't chase price and make money. That's not how you want to do it. You chase patterns, you chase valuation, you chase negative sentiment. Donovan Jackson says the past few years, energy has outperformed during real periods of stress. Even though pockets of energy currently look good, that outperformance has yet to be seen. So they're looking at performance. What is performance? Price movements. He's looking at relative price movements. So this is energy versus S&P 500. We're at multi-year lows. We are super cheap. That is what gets me interested. Not the relative outperformance yet. I get interested when things get cheap. Now, when I look at this is XLE, so this is energy versus S&P. I don't know what he used for it, but this is XLE versus S&P. This was the big oil commodity bull market move historically. When things are cheap, we had a cheap commodity to stock ratio, right? That cheap commodity stock ratio was down here. That's where I would have purchased. But you had to go through some wiggles in the beginning here. Some good wiggles, some pullbacks, then the big move, then another big move. Right now, if you look, you can see that there's a shoulder, a head, and a shoulder bottoming pattern that broke out. We are doing a retest, and that hasn't broken out yet. What I look at is the relative valuation. Are we cheap? Today, we are cheaper than the beginning of the last bull market. Now, does that mean that we are going to immediately go up because it's cheap? No, that doesn't mean that. But what it does mean is that we do have an opportunity here. The opportunity is that it is cheap, that we could be breaking out soon. So I get excited when things are cheap. That's when I want to buy something. Now, the next step isn't that XLE necessarily outperforms SPX. What we want to see is we want to see bottoming patterns in the companies themselves, which we see. That's when you go over to like OIH, like an energy service, and that's starting to head higher. So we might not see the outperformance immediately against the SPX. But what I do is I get in there and I start looking for bottoming patterns. Your ultimate bottom was here in April, May of 2025 through here. And we've been going up ever since, making new highs and new lows. That's an uptrend. So some people will say, no, we're going to go through a recession. Now you're trying to predict things. Oh, I'm going to predict when this occurs. I'm going to predict when that occurs. I'm not making predictions here. I'm just saying XLE versus the S&P 500 is so cheap that I would be in it. The relative valuation compared to history means that energy is a good buy. That's not me predicting. That is me looking at history and saying, yes, this is very cheap in relationship to all of history. That's how you make money. It's not based off predictions. It's based off of finding where the value is in the market, aka finding value. Here's one, silver to gold ratio. Look at that, right into a corner there. Big move from 1930s, 40s, all the way up to early 70s. Now, this outperformance in the beginning was, I think, because gold was not freely traded and silver was. Do you know what occurred from 1939 all the way up here? That was an increasing interest rate environment. What's going to happen here? Could we see a breakout to the upside where silver outperforms gold in the same environment, maybe something like this back here? I don't know if it will be as dramatic because I think gold was being suppressed, but perhaps we come on up. It looks good and right to do that. Now, another thing, a lot of people I know, they get discouraged by short-term price movements. This has been going down in silver. Some people are trying to call a shoulder, shoulder, head, shoulder bottoming pattern. Is it going to do that? I don't know, guys. A lot of people are trying to predict these price movements in the very short term. I'm just going to say this. We've got this gigantic pattern. There's silver there, right? It's got that big cup and handle. Do you know what else had the cup and handle? Look at this one here. Cup and a handle. Cup and a handle. It's the same thing. This fractal is the same fractal as this, and we're starting to move higher, and we have a very short-term pullback. What do you think I'm going to do? Well, it's simple. I'm just going to stay long. Now, when did silver go up? When interest rates went up. So here's the downward trend line. Here's the downward trend line. Rates bottomed in 41. We had an early breakout of silver here. And then we broke out of this double bottom to the upside and had a big old bull market all the way over here. That big, gigantic bull market. And it broke through the high here, right? Broke through that high. You guys notice that? That's the pattern I'm looking for. And that happened in an increasing interest rate environment. What do we see over on the right-hand side? Declining interest rate and a breakout. We're going to go into an increasing interest rate environment now. What do you think silver is going to do? This entire period from here to here, this here is the consolidation of a declining interest rate environment. That's what the cup and handle signifies. The cup and handle pattern is signifying the declining interest rate environment. That's what the signal is. Now, the breakout here is signaling a different market condition of an increasing interest rate environment. Now, I can also use not just yields, but other sectors, like let's use copper equities. So this is copper equities here. You guys see the pattern here. Remember that on silver there, that long-term silver chart? We had a falling wedge in the beginning of it, a double bottom, a breakout, and then we were breaking out of its high here into a big bull market for copper equities. Copper equities is doing the same thing that silver's doing and what gold's doing. And copper, the physical commodity, is going to break out to the upside. And we're going to create another valuation channel that is going to do this again. So we're stair-stepping higher. This is the first consolidation, the second one, And then we're going to create a third one. And then we stair step on top of these as we go up with time. They all say the same thing. And you know what else? This is a cup and this is a handle. Just like silver on this is a different time frame. I know looks kind of messy here as I write all over it. They all say the same thing, and this ratio chart could break out here any second. Generally in commodity bull markets, some of these like silver is going to outperform gold. So I think we're going to see a big breakout here. I also think oil is going to have a huge move. I think they're both going to move largely, like massively. Breaking U.S. housing market. Home sales on track for their worst year since the mid-1990s. Now that's home sales. It says only 28 out of every 1,000 U.S. homes changed hands this year, the lowest turnover in decades. Well, why is turnover such an important thing? Why is home sales so important? Is it even important at all? So everybody's locked up. No one's selling, no one's buying. Sales are way down. That's what basically we're seeing. Rock bottom says everyone suddenly agrees a market crash is coming. Are they ever that well telegraphed? Extreme fear. Usually you don't get market crashes during extreme fear. They're not that well telegraphed. This is Uselink. This is URA, the equities versus uranium, the futures pricing. The uranium miners, when measured against the uranium spot price, is having a touch to its upper end of the range. When we break this range either now or on the 4th, the uranium miners will outperform the metal itself, and that won't be during a massive bear market. So here we are trying, maybe perhaps breaking out for the uranium equities outperforming the uranium futures price. That happens in commodity bull markets, not bear markets. And this is a bottoming pattern here. We're going to break upward and outward. Coming down. Warren Buffett says the 3 most important words in investing is margin of safety. So what does that mean? What exactly is margin of safety? Margin of safety is when the price that you pay for an asset is far below the value of that asset. So when I use those 3 pillars that I talk about, technical analysis, market cycles, and ratios, I use technical analysis in ratios to determine the margin of safety of where we're at in the cycle. So when I look at something, I'm not just using technical analysis for my entries. I want good fundamentals. I want the company to be undervalued on a financial perspective. Now, you're going to have to use like a price to book ratio because your earnings are going to be really low at the bottom of markets. So you want to buy when things are cheap. That is your margin of safety. As things go up in price, your margin of safety decreases. So when people ask me about a certain company, let's just say company A, I'm very bullish on it in 2024. And they say, Andy, you were really bullish in 2024. How come you were so bullish? Well, the company was really cheap in 2024. That was my big margin of safety. It was very cheap. Now, since it's gone up a few 100%, you lost that margin of safety. It's the same company, but priced differently. Does that make sense? So a company and what you pay for it is the opportunity. Your margin of safety is a function of opportunity. So when I say I don't go by 20% oil, 20% precious metals, 20% whatever else in a portfolio. My portfolio is built off of margin of safety and opportunities. It's what is the opportunity at that time. Now, if I have a company that, let's say it's fair value, I'm just going to make this up. Let's say the fair value is $10, but I can buy it for $2. I have a large $8 margin of safety between the value of it and what I'm going to pay for it. Now, let's also say that let's say it's in the oil sector, and the oil sector is way down like it is today. So I'm not overpaying for the sector because the sector's cheap. I'm not overpaying for the equity that I want to buy. And let's say this company has reasonable debt. It's not going to go bankrupt. That's your opportunity. That's your margin of safety. That's how it works. And then you go around and you look for these opportunities in the markets where you get this big margin of safety. You're hopefully at the bottom of a cycle that's turning not downward, but upward. So it's down, but turning up. And that's your entry. And you just do it over and over with different sectors, because not all sectors are at the bottom at the same time. So what you'll see on the website when I go through and buy certain things, I accumulate a portfolio of certain sectors during certain time frames, and then the sectors kind of move into different sectors as time goes on of whatever's down and cheap and is the best opportunity with the largest margin of safety. Charlie Munger literally revealed the secret to winning the game of life. Let's go through it. Worldly wisdom and endurance. The game of life isn't about brilliance. It's about avoiding stupidity. You don't need to be a genius to win. You just need to not be dumb for too long. The first rule is inversion. Figure out what would ruin you and don't do it. The second is patience. The world rewards those who wait without boredom. If you gather enough mental model, physics, psychology, economics, you begin to see reality as it is, not as you wish it to be. The best investors aren't gamblers, they're collectors of wisdom. Temperament beats IQ. Consistency beats enthusiasm. The ability to stay rational while others lose their heads, that's the ultimate edge. Success is just discipline multiplied by decades. So let me break this down and try to say it a different way. What is doing something stupid? This is what stupid is. Stupid is chasing prices and buying overvalued assets. Stupid is giving into your emotional response and not doing what is rational or logic. And then he talks about understanding and seeing the world as the reality it is, not as you wish it to be. It's not being a gambler. It's investing and doing logical decisions, being wise, buying when things are cheap and waiting for the market condition to change and those assets to be repriced. Temperament is how you respond to market movements. It's not how smart you are, because if you are afraid of price movements and you react emotionally to the markets, you make bad decisions. You AKA act stupid. So the game isn't about brilliance, aka IQ. It's about avoiding stupidity, which is your temperament, and being able to handle price movements that others cannot handle. If you can do that for a very long period of time, you get rich. Another thing that he does is that since everyone is naturally set in default mode to act stupid, to quote, be an emotional investor, if you are good and you can control your emotions, your temperament, That's where you can make all your money, because what you're doing is you're going into the market when everyone is emotionally fearful and buying cheap assets. And then if you can logically repeat what I just told you right there, if you can logically get in there and not be emotionally impacted, and you do that over and over and over and over, you become very, very wealthy. And you just let compounding compound you higher with those cheap assets that you have purchased. That's what he means by that. Joseph says if Palantir paid out 100% of its profits as dividends and profits never changed, it would take 650 years for you to get your investment back. What he is saying is people are acting stupid by buying PLTR where it is. That's how overvalued it is. And if we go back to Charlie's quote, don't do things that are stupid. Do not chase price performance. Chase value. Grady says gold is now in a much needed pullback consolidation. Do not get beat down by declines or lose interest during them. Understand them, be ready for them. Do not fight yourself, just focus on price. I've been in this game for 31 years. Know if it is your system or yourself. A lot of people get scared by pullbacks, guys. It's almost like it is genetically, it's like default mode is where you chase price and you get scared when price moves against you. People do not act logically. They don't even look at the value. They know the price of everything and the value of nothing. All these quotes are coming into play here. Grady says this bull will last many more years, so do not get beat down by the declines or lose interest during them. Understand them, be ready for them, and do not fight the market. Focus on price and use that energy to improve emotional control. Plus, always know the big picture. The mother of all legit looking probable cup and handles for silver breaking out. Don't let it beat you down, guys. This thing's ready to go. Give it time. It's a big pattern, and big patterns take time to move. Natural gas on fire. A new bull market's born as it breaks out. Volumes coming in. Looking good. And that's all I've got for today, guys. So we're going to end it there. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you like. Especially with the coupon code. I will be releasing a midweek update today, so check it out. It'll be uploaded on the website. And that's all I've got. Catch you later. See ya.